Congress is looking to make several major changes to the Federal Employees Retirement System, or FERS, in this coming congressional budget plan. And the House Republicans last week passed a budget resolution that sets the overall spending amounts by each category. Now, it's going to go to the next step, which is to vote on the budget resolution at the House and the Senate, and then the committee will draft the legislation. Then they're going to vote on the bill. Just keep in mind that throughout this video, that these are still just proposals. Whether they're going to make it to the bill is still up in the air. But the House Budget Committee did approve a budget outline that would substantially cut numerous government programs that will include federal employees' health insurance benefits. Now, I know there's a lot going on right now with the recent mass layoffs in the federal government, the plan to cut 80,000 VA employees, and a plan to significantly downsize the Department of Education. Tariffs to Q1 GDP now projecting at a negative 2.4%, and now a potential government shutdown at midnight on March 14th, which is only a week from today. But I want to focus just on the first pension for this video. So if you enjoyed this type of content, just let me know in the comment section down below. And the Committee on Ways and Means, which is the committee that determines the tax policies and tariffs, is proposing to increase the Federal Employee Retirement System, or FERS, employee contribution rate to a uniform 4.4% for all federal employees, regardless of their hiring date. So currently, the contribution is 0.8% if you were hired before 2013 and 3.1% if you were hired in 2013. And if you were hired after 2013, then you're already contributing 4.4% of your gross earnings towards your pension. And this document only mentioned FERS employees and not anyone in the CSRS system. So if you've been a Fed before 2013, your contribution is going to increase from either 0.8% to 4.4% or 3.1% to 4.4%. And going from 0.8% to 4.4% is pretty significant. So be sure to keep track of what's going on with the bill when they start to draft it, because this is going to make a significant impact on your personal finances. Also, there's a lot of misinformation on YouTube and TikTok about the budget resolution. So please be sure to do your own research before coming to a conclusion. You have to remember that there are several phases before the budget bill is passed by Congress and then signed by President Trump. We're not going to see Social Security tax cuts or the federal employee pension increases in the first phases. If you don't know how the process works, take some time to get to know it. You definitely don't want to be ignorant about all this. And the next one is ending the Social Security annuity supplement for those who retire before age 62. So right now, federal employees who retire before they're eligible for Social Security, which is age 62, you get a supplemental first payment to bridge the gap until you're eligible for Social Security. And it says that it's aligning more closely with the private sector and encourages longer services in the federal government. So let's say you did 30 years of service and your estimated Social Security benefit at age 62 is $1,500 a month, okay? And your first supplement would be 30 divided by 40. Then you multiply by $1,500. So that gives you $1,125 a month, because by law, the OPM, or Office of Personnel Management, will first estimate what your full career of 40 years would be like with Social Security. Then they're going to calculate the total amount of your civil service under FERS and reduce the estimated Social Security benefit. You can always go to ssa.gov to look at your estimated benefit at age 62, 67, and 70. You also want to keep in mind that your retirement supplement is subject to an earnings test, and meaning that it's going to be reduced if you earn more than the exempt amount of earnings. So every $2 you earn over the minimum level will reduce your supplemental income by $1. So if you're looking to collect this, you have to report your earnings to OPM. And in 2025, I believe the minimum level of earnings is like around $23,400, but please correct me if I'm wrong in the comment section. So if you earn above that, then it's reduced by $1 for every $2 above the limit. And that makes sense so far, right? And then when you turn 62, the annuity supplement will automatically stop whether you claim Social Security or not. And Fed Week reported yesterday that nearly $244 million in improper payments were made to unreported debts, which allow payments to continue because of program vulnerabilities or unintentional fraud on the part of bad actors. This is all according to the OPM Inspector General report. And it says that these reports or a consent judgment in which some $150,000 is to be returned to the government for payments received by the adult child of an annuitant for 5 years following the annuitant's death until the death was discovered by a match with Social Security records. A similar case involving a recovery of nearly $88,000 paid for 3 years after the annuitant's death, discovered in a cross-check with the Treasury Department's Do Not Pay database, and a third involving more than $200,000 in overpayments over 3 years after an annuitant's death, of which $128,000 is to be recovered. And the report also added fraud by forged documents such as OPM's address verification letters to annuitants, identity theft, and other schemes are common harms. So that's going to be interesting to read even more about that. And so back to this document right here. Okay. If the proposal makes it to the bill, then people who retire before age 62 will be affected. And if you think about it, that extra $1,200 a month can be substantial if they retire in their 50s after 30 years of service. And I'm not quite sure what they mean by aligning it more closely with the private sector, but I'll let you guys know if I see a detailed comparison. And the next one is changing the FERS retirement formula from the high 3 average salary to a high 5 average salary. And they're estimating that a high 5 salary calculation will save $4 billion in 10 years. So, for example, let's say you're looking to retire as a GS12 and your salary went from $110,000, okay, and $115,000 and $120,000 in the last 3 out of 20 years of your service. Then the high 3 salary is going to be $115,000 because you add those up together and then divide them by 3, right? That's going to be $115,000. And those 3 years are usually your final 3 years of service, but they can be in any period of your service. It's not common, but it can happen if you change jobs or positions during your career. But if this gets passed, then you'll have to look at the high 5 average pay, which is the highest average basic pay you earn during any 5 consecutive years of service. So hypothetically, let's say I'm going to add $110,000 and $105,000 here, okay, for the last 5 years. Then your average salary is actually going to be $110,000 instead of $115,000. And this is either going to encourage people to stay in longer or they end up losing out on some pension income. And this is all before the health insurance deductions and taxes. And speaking of health insurance, this item on the list is to conduct a comprehensive audit of employee family members currently enrolled in the FEHB program and disenroll or remove enrollment from any ineligible individual found to be receiving FEHB. And the next one is to require future federal employees to elect between the current system with merit-based civil service protections or an at-will classification. So at-will means that you could be hired on the agency or department's discretion, but you could be fired without any justifications. You could have fewer legal protections than the merit-based employees. So this is more for like political appointees. And I think most people would take the merit-based because it screams job security, right? So that's why this document says, since a significant percentage of future civil service employees would elect to take advantage of the job protections of the current merit-based civil service system, this reform should yield mandatory savings due to the reduction in the federal agency's first annuity contribution share. And the next one is to charge the federal labor organizations for their use of agency resources as well as any official time. Federal employees subject to adverse action by their agency, including dismissal, can appeal their case to the Merit Systems Protection Board, MSPB. In the majority of cases, MSPB upholds the ruling of the agency. This policy would charge a fee of the federal employees' MSPB appeals, raising revenue while reducing the cost of frivolous MSPB filings. Okay, so MSPB stands for Merit Systems Protection Board, and it doesn't say what the cost is going to be to raise the revenue, but okay, that's more to come. I don't see a whole lot of details in there. So the next one is increasing the federal employee buyout threshold from the existing $25,000 to $40,000. That's the maximum, and that would establish a $2 billion voluntary separation incentive payment fund within the U.S. Treasury to fund those buyouts. So they're looking to reduce the voluntary early retirement or VER option from 20 years to 15 years of service. Wow. This is probably going to motivate more people to leave the federal service with more incentives. But I wonder how this is going to change the entire workforce going forward, because there will be fewer employees contributing to the pension system And I think there's going to be a deficit in the future in the pension system anyway, right? But we'll see how that goes. All right. So the next one, okay. So this is the Federal Employees Health Benefits, or FEHB, from the changing it from the premium share model to a voucher model. And I've seen this floating around in the past, many years ago. So basically, the federal government right now contributes about 72 or 73% of the healthcare premiums. So it looks like they want to combine the FEHB program with the Postal Service Health Benefits, or PSHB, and switch both of them with a voucher model. And this is going to affect the retirees too if they're using the FEHB. So the problem I'm seeing is the healthcare premiums have been rapidly increasing over the years. And if they decide to use the voucher model using the, let's say, the CPI index, or basically using the same format as the Social Security COLA, then the voucher system may not actually catch up with the healthcare premium inflation, right? And I hope that makes sense. So if the healthcare premiums go up, let's say by 5% in 2025, but the CPI index is only 2.5%, then you might end up paying more out of pocket for the premium. That's interesting. Wow. Okay. Really making a lot of changes right here. And there's something else floating around in the news cycle from political, and that's to eliminate the TSP G Fund Subsidy. Okay. So what this means is that right now, the US government pays a higher interest rate than it would for normal short-term borrowing, right? So if the yield is like, let's say 2%, then the subsidy itself will pay higher to the federal employees for investing in the G Fund. So the policymakers have proposed in the past to reduce the G Fund interest rates and let them match the actual short-term treasury rates. And I haven't had any luck finding it in the official document or anywhere else, but if you found it, please let me know in the comment section down below. And keep in mind that the bill is not officially drafted yet. So these are all speculation, but worth keeping an eye on. And Congress and the Trump administration are looking to do some extreme cost-cutting measures. And could it maybe affect the TSP match and potentially raise the rates or the fees in the TSP? Quite possibly, because the language from Congress is that they want to match what the private sector is doing with the federal employees. And I want to hear from you about your thoughts on these potential changes for the federal employees. And there are other items on that document that I want to go through, but I just wanted to focus on the federal employee portion of it for today's video. And I know a lot of you watching this video are federal employees. And if you find this kind of content helpful, let me know, and I'll continue making more every week. And if you haven't checked out my free resources like the retirement calculator, just go to firesuch.com/resources and download it for absolutely free. And I'll be back next Friday for more updates, but expect more 401k, IRA, HSA, and FIRE videos on Mondays and Wednesdays.